You don't have to think about mortgage rates when investing in property. Savvy investors, well, they're looking at things a little differently. I'm going to break it down for you in 4 sections. Now, what I'm seeing is property investors focus primarily on price and yield. Now, they want fair value for the properties that they're looking to invest in, but also they're searching for yield. Now, yield dictates the availability of limited company or SPV mortgage products. Now, the higher the yield, the more availability of products there will be for you on their specific property that you found. Now, that's specifically important because right now, on the cusp of interest rates declining, you might want to take a 2-year deal. With a 2-year deal, you need a higher yield. So yields and prices are very important for property investors right now. And this is what I'm seeing. Now, it's true. As interest rates start to drop, house prices typically will rise. No one knows what the future will hold, but you've got to be in it to win it. Sorry, I had to say that. Savvy investors are always on the hunt for their next property investment opportunity. And the reason why they do that, even if they don't have the capital available to make that acquisition, is because they want to keep tabs on the market. It's so important as an investor to understand market conditions. And the only way that you can do that is to log in to platforms such like the buy-to-let platform, link in the description below, Rightmove and Zoopla. Now, because they're keeping tabs on the market, they are able to see what's being sold, what's not being sold, at what prices, how long are the properties staying on the market for. It's all key information for them to make their next buying decision at the point that they're ready to then make the next acquisition. Now, the importance of staying in the market, even if you're not actively investing in the market, is to build up your knowledge. So interest rates really for property investors are to one side. What they want to understand is market conditions. Now take a look at this property on Rightmove. This is a property a client of mine has just made an offer on. Not because interest rates are low, because they're not. It's because the price is fair and it fits with my client's strategy. Now, if you zoom into the garage, let me know in the comments below what you think my client is planning on doing. Have you come across a recent property similar to the one I've just shown you, one that you can add value to? Are you thinking about investing? If you need help with the financing, please feel free to contact me at SPV Mortgages. Just click on Let's Talk. When those who are super sensitive to interest rates, let's call them residential home buyers, move back into the marketplace, it's going to increase demand on property. That then will lead into house price inflation. Now, according to Nationwide and Halifax, who are 2 of the biggest lenders in the UK, house prices are rising. Now, what does this mean for us as property investors? Well, it means that we could find ourselves being priced out of the market. As prices start to rise, the deposit requirement starts to rise too. But the interesting thing about this is rents are starting to stabilise, meaning when the lenders stress test the rental income against how much you can borrow, the amount that you can borrow will probably be the same. But house prices have increased. So what do? Well, you either have to buy a cheaper property or you need to increase your deposit. Now, that's okay if you're earning big bucks and you can make up the difference with the deposit requirements. However, you're going to be entering the market at a higher price. And that's not really what we want to do as investors. We want to create wealth for ourselves as well as income. Both are really important. But the point here is, as rates start to drop, the demand's going to start to increase, competition is going to increase, you could find yourself priced out of the marketplace. And to illustrate this point, have a look at this. Now, if you'd like to check out that free tool, it is completely free. It's on the buy-to-let platform. There's a link in the description below. So when it comes to property investing, it's really important to keep your goals at the forefront of your mind. And those goals could be that you want to generate 5,000, 10,000, 20,000, 40,000, 50,000 pounds a month, whatever that number is. And if you think about it, the fundamentals of property investment, the reason why we're actually doing it is to replace our income and to live the lives that we want to live at some point in the future. Okay, you're working probably really hard in your career, you're generating cash, you want that cash to work hard, and you've chosen property as your investment class. Now, when you apply your strategy to your long-term goals, interest rates you won't think about. All you'll be thinking about is, I need to earn, via my property investments, passive income, X amount of money. That means that I need to buy X amount of properties to get to that number. Now, once you focus on that, interest rates will be pushed to one side. You won't really care about interest rates too much. All you'll be caring about is, how much is it going to cost me to enter into this property? How much does it cost me to acquire? And how many of these properties do I need to buy over time? And then how quickly can I pay off the debt? Most of the debt or all of the debt, depending on your underlying strategy. So strategy needs to be at the forefront of your mind at all times when thinking about investing in the UK property market. Fantastic for the property market as a whole. It's going to be great for estate agents, for mortgage brokers, for mortgage lenders, for buyers. But is it going to be good for property investors? So if you're looking to refinance, then yes, that's a good thing. You'll get cheaper money, which means that your net yields will increase. Great, super, brilliant. But if you're looking to buy, rates drop, house prices move upwards because there's more competition. It means you could get priced out of the market. Yes, there is an argument to say, well, if rates drop, the amount of money that you can borrow will increase because the stress tests will be more lenient. However, who wants to buy at higher prices? So if you're looking to invest in the UK property market, interest rates shouldn't be the main factor that you should be thinking about. Think about the relationship between house prices and interest rates. Think about your overall strategy. Think about supply and demand. Think about how the market will look when rates do drop. And if you're going to be priced out, think about the price point that you're entering into the market right now versus the price point that you could be entering into in the years to come. Now, no one has a crystal ball. You've got to be in it to win it. And if you take these steps and think about them in detail and not be too focused on interest rates, you'll be acting exactly the same way as our savvy clients do. If you'd like to learn more about property investment strategy, click here. Please subscribe. See you soon.